time we answer a question on your stock in a little segment we like to call Your Stock, Our Take. Buy, sell, or hold. Okay, I'm going to look at a company that should be no stranger to our client base, even to just our listeners on here. XPEL Inc., symbol XPEL in NASDAQ. Originally, it was a buy from Keystone in 2017 at $1.42. Many times since we've recommended it. It trades at 64, 54. It's up over 3,200% since then. Now, market cap right now, 1.78 billion. Back to when the recommendation was 37 million. So 37 million to 1.78 billion. It's been quite the ride. What does XPEL do to produce all those returns? Well, it's a pretty boring business, but there's just great growth here, which is what we like. They're a provider of protective films and coatings, including automotive paint, protection film, surface protection film, automotive and architectural window films, and ceramic coatings. So that coating that goes on your car, that ceramic coating that protects it from those annoying scratches and dings you get from rock chips or rocks that flip up and hit your car, or somebody puts their keys against your car, that kind of self-healing film. Why the recent drop? This is the question. There was a recent drop in the share price. Strong run to start 2023 as the markets inexplicitly really rallied broadly. Bit of a dead cat bounce, but XPEL dropped in late February from its near-term high range of 78 or 77 to $80 in that range, following its Q2 results that once again produced growth, but not to the level the market and a couple of analysts that are finally following the stock had expected. Q4 highlights here: about 11.9% growth in revenues to 78.5 million compared to the fourth quarter of 2021. Annual growth, however, was in the range of 25%, so Q4 tracked lower growth. Net income increased 34.7% still to 8.4 million, 30 cents per share, up from 22 cents in the same period last year. So good solid growth there. EBITDA was 32% higher in the quarter. The Q4 was a miss from the guidance that was out there about the guidance, or sorry, not the guidance, the estimates that were out there. 30 cents per share, missed by about 14 cents. Revenues of 78.4 million, again, up 11.9%, but missed by about 5.64 million on the estimates that were out there. Now, there was some good explanation provided by management on the shortfalls in the quarter. Revenue was negatively impacted by about 3.5 million, resulting from the cancellation of some China orders due to uncertainty created by the change in COVID policy, the sudden restart or reopening of the Chinese economy. To contextualize this, XPEL's Q4 business in China is a strong quarter. The rest of the world, it's sequentially slower for the business. So the shock in China really hit hard in a quarter, which is typically a big period and powered kind of by the results and the business in China there. The company also incurred about 400,000 in inventory write-ups, which negatively impacted gross margin. SG&A were negatively impacted by about 300,000. There was another 400,000 in severance-related compensation. So some one-time numbers in the quarter there. If you normalize out those items, revenue would have grown around 17%, and the EBITDA margin would have been approximately 18%. EPS would have been approximately 36 cents per share, up from 30. So the growth would have looked significantly better if you normalize out those one-time items. Now, outlook, they have some general outlook going into Q1. Management stated automakers seem cautiously optimistic about 2023. New car inventories continue to improve. This momentum has continued, starting XPEL off to a good start to the year, they commented. So in terms of revenue guidance, management came out saying Q1 revenue to be in the range of 83 to 84 million. That's about 17% year over year in aggregate. That is assuming still China is down 20% year over year. Most of the regions like the US obviously growing at 20% plus. That's what they're looking for in terms of the quarter. Now, if we look at it, my conclusion here quickly today would be new car inventory continues to improve. It remains to be seen the ultimate impact of higher interest rates will have on new car sales, but new car buyers right now still seem to be resilient. It's likely because of some pent-up demand. Product hasn't been there for quite a while. In inventories have been weaker. I mean, myself, I went out to look at a vehicle and I couldn't even view some of the vehicles that I wanted to look at. So we're starting to see that get into a better state right now. XPEL the company has enjoyed a compound annual growth rate of 38% since 2012, growing from 10.7 million to 258 million at the end of the prior year. Perhaps the most important thing, as we don't always see this in businesses with this strong top line growth, XPEL has scaled its profits alongside revenues and growth. Gross profit and operating income margins have grown over the past 10 years significantly. The company has also produced tremendous per share growth as well, as the share count in the past 10 years has only grown by 1.8 million shares. That's about 7% of the company's shares outstanding if you go back to 2012. So that's how it's growing, but also on a per share basis. A valuation perspective right now, XPEL trades at about 31 times next year's estimates. The consensus is about 208 in terms of earnings per share next year. We see that consensus is a little bit high given the more uncertain macro environment. As such, our estimate, we have it closer to 35 times EPS for next year. We know the business well, continue to hold XPEL, but we are not aggressively buying more shares in the near term as it seems closer to fair term value. If I was looking 3 to 5 years forward, we expect XPEL as a great operator continue to be a long-term holding. So we see it as a long-term holding going forward. We're just not aggressively buying in the near term given the macro environment.
So do you recall what price multiple off of earnings we were initially paying when we bought the business back in 2018 or 2017, late 2017? Do you recall?
Yeah, I think that it was trading in about the 17 times, but that was reported earnings. But the issue there was some what we'd call hidden earnings. There was some they did a consolidation of some of their facilities back then, brought them under one roof. So there was going to be some cost savings, some one-time numbers in a couple of quarters preceding this. Basically, we had them at around 10 times roughly, right? In that range, what we would call normalized earnings. So, that can be your opportunity. You look at, a screener is going to give you 17 to 20 times, but, you look at the numbers, and this is what we're able to do, and look at the income statement, the cash flow statement, and figure out that, in our opinion, on a normalized basis, they're trading at closer to 10 times. We expected 25+% growth. We actually expected higher, but we're modeling kind of 20 to 25% to be conservative. And the company hit it out of the park over the course of the next year. We actually, it was in March. The company sat there in the $1.40 to $1, about maybe $1.50 to $1.25 range for about 4 to 6 months. March, they came out with just tremendous earnings growth. The numbers that we expected came out. They've invested those. We reiterated our buy after the stock went from about 140 to 250, just saying it was actually cheaper on a reported earnings basis then than it was at 140 because of the fact they had tremendous earnings growth. So bought more at $5, and the company continued to execute. The good thing about management with XPEL too is when we talked to Ryan Pape, who's the CEO, the CFO is great as well. If they think there's a quarter coming up where they have some weakness in China, they're not going to hide that. They're going to tell you exactly about that. They tell the market that as well, which is great to see. So, they're going to give you the good and the bad, and they've just been great operators. And that's what we like to see. So one of the, you recommend a company. We actually followed them for 4 years before we recommended it. But when you do a recommendation on a company, you're always, after the fact, you're putting a note down. They told us, for example, 10 cents per share in the next quarter. If they hit 9, you're going to have a negative mark in your ledger on that company. If they had 10 or above, you're going to check it off, and you get more certainty in terms of with what they tell you going forward and what they tell the market going forward. So XPEL keeps giving us checks in the box for the most part, right? And that's what you can hope for. And, in terms of, do we trust management if they come out with guidance? You have a higher level of trust from this team than many out there because you have experience quarter after quarter after quarter, and it's more important year after year. You can have fluctuations in a quarter, but year after year, if broadly speaking, if what they've talked about comes to fruition, you have a higher level of confidence in that. And then when they come out with earnings, you can trust that and model based on that. The flip side is obviously the opposite, right? And so you get into a situation where management, even if everything looks tremendous, if they've missed estimates for a couple of quarters or periodically over a 4-year period, once every third quarter, it's not a good quarter. I was going to say they're pooping the bed or something else, but then you have no confidence in the level of or in their guidance, so you can't effectively model the company out. So if you get a company that continually hits, then you have a higher level of confidence. And even if it's trading at 25 times earnings, but if you expect them to grow at 25% because management keeps hitting that, then you can certainly pay a premium multiple, but you can't pay that if the opposite is true.
Exactly. And that's
It's
kind
a
of
good
like the
way to
point
look at a
that
business.
I wanted to say, just like look at that multiple expansion that we saw from a company going from just breaking into profitability to all of a sudden, compounding year over year of like you said, 38% CAGR. I don't know how long that was. But,
Yeah.
and
10
then
years.
also growing, EPS. Like it's crazy, the multiple that a company can come to demand in the market as, it has this great track record. And then, of course, like when the company did report these most recent results, it did kind of spook the market, of course, as, they're kind of wondering, can this growth rate continue? Which, the stock did take a hit, but, still a great.
Yeah, I mean,
business.
we've seen in the past, like they've come out with they've had a quarter where they've had issues in China, and then it's recovered completely,
Exactly, and that's the
essentially from
thing,
that.
and it's not something
The only
they
issue
could
would be, I
expect.
guess, sorry, not to cut you, but I'm gonna
Please
anyways.
do.
But sorry, no, I was gonna before I forget. I'm older than you, right? So you never know. I might just forget what I was gonna say. But in a quarter, they could say in China they're gonna have an issue, but if they don't recover, and if it keeps happening, then you start to put a negative in the box. But they have in the past done that. The issue in the past, not the issue, but in the past, they had said, okay, we're going to recover in the quarter. They weren't trading at these absolute premium multiples, right? Mm-hmm. Say 3-4 years ago. So we have a quarter that misses and trading at premium multiples. Well, if there is a miss and you're trading at premium multiples, no matter how quality a company you are, we typically see a hit to the share price, right? We expect them to recover. There's growth in other areas. They keep expanding. It was protection film primarily for years for vehicles, right? Now they've brought on, architectural film. And so they're trying to grow that business, I think, 25% organically. And so that's good. If they can continue to do that, there could be other expansion.
Yeah. And it would be different if like something fundamentally changed to like the business itself, where again, like the reason we're kind of seeing a slowdown in China is just because we saw, them kind of revert back into more of a lockdown phase. Anyways, we can
or it's the opposite.
Or was it the opposite? Sorry, was it because they opened?
Yeah, it kind of shocked the market they you're going to an opening market, right? And then suddenly, distributors have to get product in, and there's a number of things that have to. The economy doesn't start up like that.
Exactly.
So yeah, I mean, but the thing you were talking about too, just the tremendous thing that's led to tremendous gains in the share price, revenue growth, tremendous. But like profit growth, just operating leverage, the continue to uptick margins it's such a powerful way. That's how they've gotten to a higher multiple over the long term too, because they continue to work on SG&A. They continue to, get more operating leverage the bigger they get, and replicating that model. Like it's like a Boyd taking their model into this market, into a new market. But the companies in Canada and the US, then they move to Europe, then they move to Mexico, to China, and through other areas of Asia, and they just keep, using a similar model that XPEL I'm talking about now in different countries, and they're doing tremendously well at it, and it's it is very well run. So
and the thing is nice when you're partnering with these people who are basically like putting on the wrap for you, it's pretty easy to expand that way.
Yeah, and now they're going close to the customer, the strategy where they're owning the installers, right? And they just released a new software. I mean, it's
It's awesome.
It's a well-run machine. It continues to oil the machine well. It continues to increase in terms of profitability, and we expect that to continue. It's just been at a premium price for a little while here. So, I'd love it to come significantly on sale. I know it sounds always hard for an investor that's in it right now to say, but if it comes off 25%, maybe you really want to buy some more if they continue that to fix that growth rate over the course this year, which we expect them to do. The one thing it keeps you up a little is higher interest rates. I mean, if people just stop buying cars, it'll hurt the company in the near term.
Yeah.
Then we'd probably get a chance to buy some more.
I'm still kicking myself. I didn't buy any at $16 during 2020.
You should just keep kicking yourself.
Yeah.
You learn from the pain, right?
Yes.